Greg, to start with you, though, as well, I mean, you've been equally as resolute in your view, even though you do acknowledge parts of your view for, say, 3,800 was a little bit too early.
Right. And so the view for 3,800 is based on what I see for 2024. And remember, we're in leg 3 of my bear thesis. You know, the first leg was the Fed needed to raise interest rates in 21. When they didn't do that, I predicted a hyperinflationary environment in 22 and then having to raise rates aggressively, which is what they did. But there's consequence to that raise, to that 500 basis points. And what we saw in the first half, what I think screwed my timing up a little bit, is that we saw a really significant amount of government stimulus and government spending. When you look at that GDP number for the second quarter, a lot of that was government spending. We have the CHIPS Act, we have the CARES Act, we had the bank bailout, we have the employee retention credit. We have all kinds of stimulus that went into, I think, buoying the consumer in that first half. And I'm wondering if the runway isn't running out. And so this last leg of my bear thesis is what happens on the other side of that aggressive interest rate increase. And I think we're just beginning to see some of that in the early cyclicals. We're seeing the consumer, the stretch and the pain that's being thrust upon the consumer, both in terms of those rising delinquency rates they referenced in the last show, but as well in terms of the record credit card debt, as well in terms of other areas where we're seeing stretched consumers and stretched spending. And so I do expect that to curtail in the second half. And when you get a curtailing of spending, a curtailing of demand, when you get continued disinflation from continued demand destruction and the Fed continuing to push those buttons, I don't see a path from this quarter's negative 5% earnings to flat earnings in the third quarter, or 8% earnings in the fourth quarter, or 245 in 2023. And so if I can make that math work, I'll get more bullish, but I can't see that right now.
Right. Interesting, guys. You know, as we're chatting session highs here, as we're back to 4,400, John, I do wonder, I mean, there had been this discussion that unless the market, if the bears were going to break some of the generals, like, for example, NVIDIA, and we'll see what the rest of the week brings, but without that, whether or not we were truly in, once again, a sort of buy the dip environment. Do you think today's action sort of reflects that?
You know, it's really interesting. Technology obviously has been the clear leader. Now, let's not forget they were the most beat up. The NASDAQ was down 35% peak to trough. So I think it's very important to contextualize the technology names, Meta, Salesforce, Google, Amazon. These were left for dead back in October. Nobody wanted to own them because interest rates were very high. Now you have an AI frenzy, which is being led by NVIDIA, and you have very strong fundamentals. I'd be shocked if NVIDIA doesn't put up a good quarter given all the demand. So I think that all of those bode very well. One thing that I'm a little bit concerned about is the very reason that people sold technology they're ignoring, and that was interest rates. I think the real opportunity, Carl, actually lies in the interest rate sensitive areas. So the areas that nobody wants to own. You need to look at banks, you need to look at REITs, and you also need to look at China. Why China? Because China is being impacted by the dollar, which is tied to interest rates. All of those interest rate sensitive areas are on sale. And while I totally agree that the slowing of credit absolutely will have an impact on the consumer, you have a lot of discounting that's already happened, even with the comments that came out and downgraded some of the banks. That's not really surprising. That's like telling someone to put on sunscreen after they have a sunburn. That's already really out there and in the news. So I think that we have a lot of discounting that already occurred, and there's real opportunities. And what if we actually get a steepening yield curve? That would be a great opportunity for the banks. And the other piece that I'll say, and then I'll shut up and let someone else have a comment, is now you're getting all the defensive areas, which were egregiously priced back in October, building up to that recession play. Those are now on sale. Utilities are now trading at some of the cheapest valuations that we've seen in 6, 7 years, even 10 years in some cases. Nobody wants them because, again, they're tied to interest rates.
Yeah, no doubt that some of the new lows that we get day after day are starting to look awfully familiar. Greg, I wonder sector-wise with you as well, if there are pockets that you like, or if your macro view is negative enough that you just are not interested in equities whatsoever.
Well, just to dimension my view, I see 225 next year, so I'm at 3,800. So it's not that draconian, but going back to the financials, what we've seen so far is this should be a great environment for net interest margin expansion, yet that's proven very hard to come by, even by some of those large money center banks that were a net recipient of all the troubles we saw in the first half of the year with deposit flight fleeing to them. Even they couldn't produce much in the way of net interest margin. And I think that that will continue in the macros. So I am less enthusiastic about large banks. I think they'll take the provisioning up more than people expect in the next few quarters due to some of those delinquency rates being higher than we expected. And on the tech side, frenzy to me is a word akin to bubble when we use the word frenzy. And indeed, while AI will be a secular tailwind, I think the market will use the next 2 quarters to sort out what companies like NVIDIA are having a real impact on their business from AI versus those where it might not be there of that magnitude, or it might be 2 or 3 years away. And should we be bidding those companies up? Net, I think the market will start to refocus around companies that can deliver double-digit earnings growth and that can show us margin expansion. We see some of that in healthcare. We saw some of that with Palo Alto, although they gave the market a little bit of a heart attack with the Friday night earnings announcement. And so that's what I think the market will start to look for as my macro view comes more into being a reality as opposed to what some think is a passing fancy.